So
Okay.
it's all yours.
All right. Thank you, Gary. And thank you, everyone. Thank you to the Arlington Neighborhood Village for having me this morning and Miss Connie for suggesting that I do this. She was asked me if I would be willing to do this presentation. As Gary mentioned, there's a lot of material. Um, the One Big Beautiful Bill Act made a lot of changes, and we'll go into some of those at a very, very high level. And there's some holdovers from the Secure Act 2.0 when Biden was in office that I want to bring to your attention. So there's a lot of material. I'm going to cover everything at a very high level. So if we have time at the end, I'll be happy to take some individual questions if I may. So let me figure out how to share my screen. That probably would help so you can play along with me. I will make Gary, if you'd like, or I can email this to somebody after. So this way, if people want a copy of it, the presentation, they can have it.
Yeah,
If
if you probably best to send it to Wendy since
okay,
they'll have it at the office and can send it to anybody that calls up and wants it.
wants it. Okay, alrighty, I will do that. Let me just make a note. Okay, so as Gary said, my name is Carol Phillips. I am the owner of a small tax practice. I live out in Front Royal with my husband and my puppy, who is behind a locked door because I didn't want him on my lap trying to interrupt uh, our little conversation this morning. There is my contact information. You can see there. A little bit about me. I'm an enrolled agent. I've been in the tax practice world for over a decade now. I'm thinking it's maybe more like 13 years or so. I started my career with H&R Block a long, long time ago. Um, Became an enrolled agent, went out and started doing some contract work for some CPA firms locally to gain more experience and knowledge. The client base that H&R Block attracts is different than the client base you would see at a CPA firm or another type of tax practice firm. So I wanted some more experience and did a lot of contract work with some CPA firms and then started my own business 3 years ago. I'm 100% virtual out in Front Royal. With the onset of COVID, that made that a little easier for people to accept and be willing to work virtually with tax pros. So there's a little bit about me. So there's this quote I found on the internet from that was attributed to Morgan Stanley. It was on the internet, it must be true, right? So, but it says, we have to pay taxes, but there's no law that says you have to leave a tip. So that's where your tax planning comes into play. We're having good knowledge about the new tax laws come into play because yeah, we want to pay our fair share, but nobody says we have to pay more than our fair share, right? So let's not leave the IRS a tip, give them more and take full advantage of all of our deductions. So hopefully the new tax law changes will benefit everybody. So our agenda today, there's a lot on the agenda. Let me shorten this up a little bit. I always like to talk about how we can prevent tax identity theft. That's a huge problem. Millions of people are get their identity stolen and fraudulent tax returns filed. The last stat that I saw with the IRS was it takes over a year. It's taken over a year for them to resolve tax identity theft cases. So we try to prevent that as much as possible. As I alluded to, there's still some lingering tax law changes from the Secure Act 2.0 for 2025 and 2026. The One Big Beautiful Bill Act has some permanent changes for this year, and then it's got some temporary changes that start in 2025, and then there's some temporary changes for 2026 because Congress just can't make things easy, right? We're going to make some things permanent, we're going to make some things temporary, and we'll go over all of those in some detail here in just a minute. So let's talk about how you can prevent tax identity theft. The number one thing that we always like to ask people to do is to create, if you're tech savvy and don't mind doing things online, is to go to the irs.gov and create your own individual online account. You can go in that account at any time. You can check on any payments that you made, your tax records. You can see what's going on your account on any given moment. And it's a quick way to see, you might be able to identify fraudulent action on your account before the IRS even notices. And you can even make online payments there. Another way is to apply for identity protection PIN. Go to the IRS website, apply for a PIN. I believe it's 7 digits. And you have to, that prevents somebody from filing return using your social security number. This PIN has to be reported on your tax return every year. The downside to having a PIN is it changes every year. So you have to, you can either go into your online account and see what that PIN number is, or they will mail you a copy of that PIN number every year. So that helps prevent tax identity theft. And then finally, the IRS, the Social Security, Medicare, nobody's calling you, okay? They're not going to email you. If you get a phone call from somebody threatening they're holding your granddaughter hostage because you haven't paid your tax bill, okay, that's a scam. You know, whatever, however you choose to deal with that, just hang up with them. Generally, all of the government agencies, their first contact is going to be via email, okay? Unless you already have a relationship established with the revenue agent, which I hope nobody ever has that. Your first
So
contact.
Carol, you meant to say first contact will be physical mail, not email.
Yeah, did I say yes? I said
Yeah.
email, but thank you for pointing that out. Yes, it's via mail. Yep, you're going to get that letter in the mail. Okay, they're not going to call you, they're not going to text you, they're not, okay. So if you suspect that it's fraudulent, pick up the phone and call the IRS and ask, hey, I got this text message, I got this email, and check in on them. Okay, don't fall for the scam. Okay, let's get into the good stuff. So, tax law changes for 2025 under the Secure Act. This was something that was held over. It was not changed by the One Big Beautiful Bill Act. There's just a couple of items that I want to point out real quick. This provision allows for what we call special catch-up contributions. So if your age is between the ages of 60 and 63, you can see here that you can make an additional $3,750 additional special catch-up contribution. Okay, so if you're under 50, you can see the numbers here. I'm not gonna read through everything, but I wanted you to be aware of that new this year for 2025, you can make an additional $3,750 contribution to your 401, 403, etc. Okay, so that increases your, now here I told Wendy I wasn't going to do math, but here's a good case for math. Did I make that math note? Um, I did not. So you can increase your 401 savings this year. And this is a permanent change, okay? The other thing that Secure Act 2.0 did was it directed the creation of what they call a retirement savings lost and found database. So those of us that are a little older and have had several jobs and have had participated in a 401 plan at a previous employer that we may have forgotten about, right? You can go to this database. I have not looked at it, so from what I understand, you can go to this database and put in your information, your social security number, your name, and verify your identity, and it will tell you all the retirement plans that you may have forgotten about. So there might be some money laying out there, right? That you might want to think about claiming. Okay, let's get into the 2025 permanent changes for the One Big Beautiful Bill Act. This is just a high level of all the different topics we're going to cover. Some of the TCJA provisions were made permanent. They expanded them, they enhanced them, and we'll get into all of these in the next couple of slides. And then you can see they eliminated some of the credits also. The green credits were eliminated. So this is permanent changes that take effect this year in 2025. So they're going to affect this next year's tax return filing. So let me back up. One of the things that the QBBA did was it permanently extended the lower income tax rates and brackets. Okay, so that creates lower tax liability for most people, okay, the expansion of these tax brackets. So here you can see what the tax rates are under the QBBA, and what the thresholds are. So in this example, like the 12% tax bracket starts at $24,801 of income. Okay, so that's what those threshold numbers represent. So they eliminated, I think there was a 25% tax bracket, a 28% tax bracket. So they lowered the tax brackets and lowered and increased the thresholds to reduce your tax liability. So that's just a real quick glance at that. Um, the standard deduction under 2025 was the higher rates were made permanent. You can see for a married filing jointly, your standard deduction is 31,500. If the TCJA would have expired, that standard deduction would have been 16,700, right? But you would have also kept your personal exemption for each person that you can claim on your tax return. So just at a quick glance, you can see that these higher standard deductions is going to especially benefit people that can no longer itemize. The other change for 2025 was the qualified resident interest. So the amount of loan interest that you can deduct if you're able to itemize your deductions. So it's a lower limit for loans incurred after December 15th of 2017. It's lowered to $750,000 of mortgage interest. Or excuse me, that's your AGI. Once your AGI goes above, no, I'm sorry, that's your mortgage interest. So anything above that amount, if your loan amount is higher than $750,000, it's limited to how much you can deduct. And there's a formula, a phase out formula for that. If TCJA, if they would have allowed it to expire and it went back to old rules, you would have had $1 million that you could have, up to $1 million of acquisition debt that you could have written off. Okay, so this here, the QBBA changes have been in effect, that this is your TCJA numbers. So we've been dealing with these for the last 4 years. The other thing, for those of you that claim children on your tax return, your child tax credit is for this year is $2,200. If it would have expired, the TCJA would have expired, it went down to $1,000. So we all know our children are more expensive, right? That $1,200 a year credit helps a little bit, but it's better than $1,000. Okay, your green credits. The credits for electric vehicles, your solar power, your solar energy, your batteries, your solar batteries for storing energy, and the energy efficiency home improvement credits, doors, windows, geothermal heat, some of those type things, they're all gone, right? We know that this current administration has no taste for green energy. Everything's been eliminated. However, if you did install them prior to December 31st, 2025, you can still claim the credit this year, but they are gone for next year. Electric vehicles, if you purchased your vehicle after September 30th of this year, you're going to lose the credit. So they are completely eliminated under the One Big Beautiful Bill Act. So let's talk about the temporary. I made mention of the fact that there were some temporary provisions. These are the ones that are effective this year that are to affect your 2025 tax return. They expire after 2028. So that means in tax year 2029, unless they extend these, all these provisions are going to go away. Okay, just so happens. So these are the ones that are effective that you can take advantage of this year. And we're going to go into each one of these in a little bit of detail. So your state and local taxes. This is for our itemizers. If you can, excuse me, if you can itemize your deductions. Prior to 2025, you remember our SALT taxes were limited to $10,000. So if you had real estate taxes, for those of you in Arlington, that's your income, your real estate taxes are much higher than mine, right out here in Front Royal. So this new change is going to benefit you. So in 2025, your state and local taxes, you can deduct up to $40,000 instead of the 10 that we were limited to. So your real estate taxes, your personal property taxes, any state income taxes that you pay, like withholdings from your W-2, now we get to take up to $40,000 if you're married filing jointly. Married filing separately is 50, is half of this, is 50% of this number. So you can see they increase every year. And then in 2030, going forward, they revert back to the $10,000. Okay. And then they also put a deduction in there. So if your modified adjusted gross income, if your total gross income exceeds these numbers, so in 2025, if they exceed $500,000, that deduction is going to start phasing out. So you might not get the full benefit of the $40,000 deduction. Okay, so this is a big help, $10,000 versus $40,000. So we're expecting to see some more people be able to itemize this year using that. Some of the other temporary provisions, these were no tax on tips, no tax on overtime, were big campaign promises, right, this year. So the no tax on tips, up to $25,000 per tax return, you can deduct your qualified tips.
Alexa, turn on desk light.
Okay.
There's an income phase out with that. So once your income, you can see here, if you're married filing jointly, if your income starts exceeding $300,000, that deduction is going to start phasing out. And you cannot claim this one if you're married filing separately. No tax on overtime. You can see the deduction amounts there. If you're married filing jointly, you can deduct up to $25,000 on a tax return. It's not per person, it's per tax return. Now, the interesting thing about the overtime, the way they calculate the overtime, it's the amount that exceeds the regular rate. So if you get paid time and a half, let's just say you make $20 an hour and you get paid time and a half. So the amount that exceeds the regular rate is $10, right? For your overtime rate. So it's that $10 an hour that you're going to deduct for your overtime. Okay, it's not the full $30, it's just the $10. It's the amount that exceeds the regular rate. And you can see the income phase outs also. So once you reach $300,000, you are no longer, it'll start phasing out the amount that you can deduct of your overtime. And once again, you cannot claim this if you're married filing separately. All right, new for this year, and also a temporary provision, is if you have vehicle loan interest, you can deduct that from your tax return. There's a lot of requirements around this. What type of loan, what type of vehicle, it's got to have at least 2 wheels, which that makes sense, right? So I would suggest that you reach out to a tax person or consult the IRS pubs if you have questions about how this works. This is per tax return, $10,000. And you can also see that this one phases out also. So once you hit $200,000, the amount that you can deduct starts reducing. And now this is the interest. It's not your total payment, it's your interest that you pay. I'd like to point out with these three provisions here is these reduce your, you can take these whether or not you itemize, okay? It's a deduction that everybody gets on off the front of their tax return.
Amazingly functional, despite her disabilities.
Okay, let's get to the real good stuff. The senior deduction. This is another temporary provision that affects this year. Contrary to what you may have heard on the news, this does not eliminate taxes on Social Security. Your benefits are still taxable. It may reduce your overall tax, right? Because we know up to 85% of your Social Security could be taxable. It may reduce the amount of tax that you pay, but it doesn't directly, how do I want to say this? Your benefits are still going to be taxable. Okay. It was just a play on words to get, we're not going to pay tax on Social Security. What a great campaign promise. It's also not tied to the recipient of Social Security benefits. So if you are 65 or older, and let's say you haven't started drawing your benefits yet, you can still take this deduction, okay? It's not tied to receiving your benefits. So that's an important piece that there's a lot of misunderstanding about. I've already said you have to be 65 and older by the end of the tax year in order to claim this. It's $6,000 per qualifying senior. So if you're married finally and jointly, you both are over 65 or older, you can both claim this deduction, and it would give you another $12,000 of reduction to your income. There's also phase outs though, these phase outs. If you're $150,000 married finally and jointly, once you hit that number, your $12,000 is going to start reducing. Another one, you can't claim this if you're married filing separately. So they're really trying to encourage people, you have to file jointly in order to claim a lot of these new deductions. Okay, 529 plans. 529 plans are a great way to save for college and kindergarten through grade 12 education for our children, grandchildren. They can be used at tax-free distributions. There's $10,000 per student right now for 2025. They changed the law this year to create the ability for additional education expenses, to use that distribution for additional expenses. So books, tutoring, any other expenses that are associated with attendance at an elementary or secondary school, you can now use those 529 plan distributions for. Previously, you could just use them for tuition. So starting this year, you can use them for, like I said, books and everything. New this year, we call them post-secondary credentialing expenses. So if you have somebody that goes to school, let's say want to be a CPA, or in my case, an enrolled agent, I had to, in order to get my certification, I took a class, I had to take a proctored exam with the IRS. I had to pay fees to the IRS in order to get my credentials. So all of those expenses, if I would have had a 529 plan, I could have taken a distribution out and paid for those credentialing expenses. So that's a nice change for this year. The key to this is those distributions only apply to anything that was made after July 4th of 2025. Before then, technically, you're not supposed to be able to deduct or use those distributions for these items that I just mentioned. And we're going to talk more about 529 plans. With all the changes recently, this is a great way to help build some generational wealth with your 529 plans. But we'll get to that at the end. All righty, let's go into 2026. So for next year, one of the changes under the Secure Act, if you make catch-up contributions if you're a high earner, and by a high earner, the IRS says if your wages exceed $145,000 in the prior year. So in 2026, you look back to 2025, my wages exceeded $145,000. And if I want to make catch-up contributions, they have to go to a Roth 401k. And that's only if your employer offers them. Okay. So that's, if your employer doesn't offer them, then you're not going to be allowed to make those catch-up contributions. But just know that if you want to make them, they have to go into a Roth 401. All right, permanent. Some of the permanent changes, the One Big Beautiful Bill Act for 2026. You can see the list here. We're going to go over all of these in detail. So these are all your permanent ones. So let's start with the 529 plan. The big change for 2026 is it increases the amount of a tax-free distribution you can take. It's $20,000 per student. This year it's 10, next year it'll be $20,000 that we can take. Trump accounts. I just love these Trump accounts. So they're a tax deferred savings account. It's a way to encourage people to save money for their children. It's another way to build, it's a great way to build some wealth for your children or your grandchildren, as the case may be. So you have to be under 18 in order to have one of these accounts. they're post-tax contributions, so you cannot deduct the contribution on your tax return. So it's going to be, it's the money in there is already going to be paid tax on. So when you start taking distributions from it, if they're qualified distributions, you won't have to pay tax on that money. So here's how they work. The treasurer, I don't know how it's going to work. I don't know how the treasury is going to do this. I don't know the specifics of all of this. They haven't really gotten into that. But for children born after December 31st, 2024, so children born this year and before January 1, 2029, the government is going to contribute $1,000 into this Trump account. Like I said, I don't know the details of how that's going to work. The caveat in this is the contributions are not permitted until July 4th of this year. Okay, so they're not going to put money into it until July 4th of 2026. I suspect that's a chance for them to try to figure out how this is all going to work. So the contributions are not going to start for the IRS or excuse me, the Treasury, or even taxpayers. If you want to put money into these accounts, we can't do that. The annual contribution limit is $5,000. So up to $5,000 can be put into these accounts for our children. And when they turn 18, this account must be converted to an IRA. And then all of the IRA rules then start applying to that account. Early withdrawal penalties, those types of things. So you can put it into an IRA at 18, and then the holder of that account can still contribute money, the $7,000 or the $8,000 or whatever the amount is that you can contribute to your IRA. You have to have earned income, all of those things. But the takeaway here is, your children are born this year, you can put $5,000 a year in for 18 years and then continue to put money into it once they hit, they roll it over into an IRA and start putting money into it when they're 18. That's a great way to build wealth for our children, to start saving now. Something to think about. The other permanent, excuse me, with the scrolling, the other permanent change is this only affects you if you're in the 37% tax bracket. Your itemized deductions may be limited. There's a big formula and phase out and all these rules around that. So if this affects you and you want to know how it will if you're in the 37% tax bracket, I recommend you go work with a tax person to see how that's going to affect you next year. All righty. Permanent provisions, more of them for 2026. If you take advantage of a dependent care assistant plan where you work, this is where your employer will put funds into like an FSA for you to use for dependent care expenses. It's been increased to $7,500 this year. This is tax-free money you can use towards paying for childcare. You can see it increased from 5,000 to 7,500. That's for 2026. Back again, mortgage insurance premiums. These things, they come back, they go away, they come back, they go away. I don't know how many times I've seen the deductibility of your mortgage insurance premiums go away in the 12 years I've been doing taxes. But if you're paying PMI, you can now start deducting that if you can itemize in 2026. But here's the catch, there's a phase out. So if your adjusted gross income exceeds these numbers, the amount of your premiums that you can deduct starts phasing out. But they brought it back, it's a permanent thing now, you can deduct PMI. The estate and gift lifetime exclusion. So the amount of money that you can gift to people is now in 2026, it's going to be at $15 million. That's going to be indexed for inflation. This is a permanent increase. Okay. And what this means is, and I don't remember what it was this year. I think it was like down at 13 or 12,000. So anyways, permanently increased to $15,000. Okay, let's get to the one I know that we had some interest in. Where's Miss Mary? Is Wendy still on? Is she? So we talked a little bit about this before everybody joined us. Charitable contributions. So this takes effect in 2026. Okay, If you do not itemize your deductions, you can make you can deduct your cash contributions up to $1,000 if you're a single filer, or $2,000 if you're married filing jointly. Cash contributions, okay? Off the front of it reduces your gross income. If you itemize and you have charitable contributions, starting in 2026, they're going to be subject to a 0.5% floor of your AGI, just like your medical deductions, right? Your medical deductions are subject to a 7.5%. Your charitable contributions, if you itemize, are going to be subject. You're going to lose the first 0.5% of your charitable contributions. If you have $100,000, if your AGI has $100,000, you're going to lose the first $50 of your charitable contribution. So not a large impact, but still it could be significant. If you make QCDs, if you can make qualified charitable distribution, you can still make those and take these other deductions. Okay, so here's a way to strategize, and we'll talk a little bit about this on my next slide, but you can strategize and still make your QCDs. You can make some cash contributions, and whether or not you itemize or not, so you can get the benefit that way. All right, the takeaway with this is there's no double dipping. So if you do a QCD and you give $10,000 to the Arlington Neighborhood Village, you cannot take $1,000 of that and also deduct it on the front of your tax return. Okay, so no double dipping. So that's the big change with the charitable contributions. So let's, before we move into tax strategies and ways that maybe you can look at those charitable contributions, I wanted to point out there's a whole lot of other changes in the One Big Beautiful Bill Act that I did not highlight or go into. The ones that we talked about are the ones that we see more frequently that affect the most people. Okay, so if you have any of these other credits, expenses, you may want to take some time to look at the changes around these. Like I said, we could have been here for hours talking about some of these things. What I do want to point out, though, is the premium tax credit. If you receive your health insurance through the Affordable Care Act, through the Marketplace, Obamacare, however we want to call it, there was a lot of changes to that premium tax credit, which is where the government helps pay for your health insurance premiums. There was a lot of changes around that, especially for 2026. And I purposely chose to stay away from that topic. There is so much going on right now in Congress and with the president around the ACA and around tax credits, and I have a feeling a lot of that's going to change. So I didn't want to give you information now that it potentially is going to change next year. Okay, so if you're subject to that, I would pay a lot of attention to that, or work with your tax professional around that. And this one I found interesting. No unemployment for millionaires. I didn't know. So anyway, they actually put it into law that if you're a millionaire, you cannot collect unemployment. So there you go. So I didn't know that was a thing. So we know that now. All righty. Gary, let me take, I'm really ahead of my schedule here. Is there any questions, or before I jump into strategies? I'm going through this a lot. I can see the questions here. Yes, Miss Catherine, I will give this slides, and I apologize. I should have made those available ahead of time, but I will get those to Wendy. And the $1,000 per child, can you tell me what that was in reference to, that question?
I'm guessing it was the Trump accounts.
The Trump accounts, yes, $1,000 per child. Yep. Yeah. And I asked Alexa this morning, oops, that might have been she didn't go off. There's one in my office. I was like, I asked her this morning, how many children are born each year in the United States? There's 4 million children born in the United States each year. That's a lot of money. That's a lot of money. Okay.
So we've got a question here about estimated tax payments.
Okay, let me give me a chance just to read through this really quick. nearly or fully paid. Okay, if I understand this question, if there's a question about estimated taxes, if so the way that the estimated taxes work, you're supposed to the tax system is a pay-as-you-go type system, right? So if you have to make quarterly taxes, you make them 4 times a year, you're expected to pay that tax in full for the amount of money that you made that quarter. So if a 2025 tax return is submitted on 26 and most, if not all taxes have already been paid, but not on a quarterly, but throughout the year. Okay, so yes, the answer to your question is yes. If you make your estimated tax payments and they're not enough to cover that quarter, you're going to get you're going to get penalized for it. So you could have made a large lump sum payment towards the end of the year, and the IRS, even though it was enough to cover your estimated taxes, the IRS is still going to penalize you because they're going to say you should have paid those penalties on an ongoing basis quarterly throughout the year.
Can you expand a little bit about what being an enrolled agent means?
Certainly. Yeah. So what it means is I don't want to use the word license. I'm certified. I'm not supposed to use the word license. I'm certified to practice in front of the IRS. So that means that I can represent taxpayers in front of the IRS on if there's problems with their tax return, if you get audited, if you have an offer in compromise that you want to make, all of those things, I can legally represent you in front of the IRS with a signed authorization. That gives me the same privileges as an attorney, as a CPA, I said attorney in front of the IRS. So what that is a special credential that, and I mentioned this earlier when we talked about using your 529 distributions to pay for credentialing, right? So there's in order to be an enrolled agent, there's a proctored exam that you have to sit for. So I had to go down to Falls Church and sit in that little exam room and close book exam. And it was a 3-part exam that it was pretty intensive. It was 200, I think each part there was about 200 questions each part, closed book exam, and you had to pass all 3 parts. And then of course pay the IRS a fee, right, to get their little piece of paper that says you're an enrolled agent. So it's just the exam is on tax law, individual tax law, business tax law, ethics, trusts and estates, on anything to do with taxes. So it's just a designation that allows me to practice and represent people in front of the IRS. So.
Okay. And Steve asked, does that apply to certified financial advisors?
No, that's a different credential. That's a different, yep. And I don't think certified financial advisors can represent you in front of the IRS. Now, having said that, you could, never mind, I don't want to go there. Excuse me. Okay, so certified financial advisors cannot represent you in front of the IRS. So.
Okay, a number of the deductions you talked about, you said, it's this much if you're married filing jointly. You can't claim it if you're married filing single, filing separately. What if you're not married at all? Are those deductions available? Maybe half as much?
Yes, good question. Yeah, it's generally half. Let me see if I can go back to a slide where I called that out. I like let's see if I can find it. Sorry for all the scrolling here. Let me go back to a good example.
Yeah, there's one.
So yeah, we'll talk about like the no tax on tips. So if you are married but you file separately, you cannot claim that deduction. Okay. So if you are the $150,000, when we talk about the income phase out at the $150,000. So if you file if you're single, if you're head of household, your income will start phasing out on $150,000. If you file married filing jointly, it'll start phasing out at $300,000. So you're still eligible for the credits. There's just a different income threshold that where you start losing a benefit from it, and that depends on your filing status. Um, and the senior deduction, you can't claim at all if you file separately. So they're really trying to encourage people to file jointly. Does that answer your question, Gary? Or was
Yeah.
there something else? Okay.
Um, and now we got a question. I think you've touched on this, but maybe go back over changes to gift taxes.
Okay, yep. So the gift tax, what they just did was increase the gift tax amount to $15 million. So that was pretty much the big change. The base exclusion is $15 million for the gift tax. So after that, that's when you have to start paying your taxes on gifts, right? What else
And
do
a
we?
question here about TCJA. Has it expired, been extended? Can you go back over that a little bit?
Course, yep. So the TCJA came into effect when in Trump's first term, right? And it was scheduled to sunset or go away at the end of 2025. So the QBBA, so TCJA is gone. QBBA now either enhances some of those provisions, it eliminates some of those provisions, and then QBBA, that's such a mouthful. And that also added some new provisions. So the new ones being your no tax on overtime, no tax on tips, your senior deduction, things like that. So TCJA is gone, okay, effective this year. Does that help? Miss Tammy, did that help? Where's Miss Tammy? Is she, okay, thank you.
And
Okay, good. I saw your answer. Yep.
yes.
Okay.
Okay, and I don't see any other additional questions.
Questions. Okay, let's get into some all right, we already talked about so tax strategies. So let me start by saying, and there's this disclaimer, I tried to put it on as many screens as I could, that things that I talk about, any strategies, it's I'm going to talk at a very high level, okay? Because the strategies are going to be different for every person, depending on what are your goals? What is your income? Are you married? Are you not married? Do you have children? So it just so many different things that play into a tax strategy or a tax plan for somebody. So if you really want personalized advice, I would really strongly recommend you work with somebody over this and kind of take a look at how it's going to affect you. So I'm going to keep these strategies at a very high level, and I apologize for that in advance. But anytime I get asked a question about taxes, my first thing is it depends, right? It depends on what your income is, are you married, et cetera, et cetera. So let's talk about bundling your charitable and your medical donate or your medical donations aren't really donations, sorry. So you're going to bundle your charitable donations and your medical deductions. So if you don't itemize, if you haven't already made your cash contributions for this year, for 2025, a lot of people like to wait until the end of the year and make some cash contributions. If you can't itemize, if you don't itemize, you might want to consider delaying those to 2026. Because if you don't itemize, you're not going to get any benefit in 2025, right? So if you wait until 2026, at least you can get a benefit of up to $1,000 or $2,000 if you're married filing jointly. Okay, does that make sense? So if you've already made those contributions, no harm, no foul, but just know that next year, if you don't itemize, you can take those cash contributions. If you do itemize your deductions, and now here's one of those, it depends things on your personal tax situation, but if you made your 2026 contributions this year in 2025, it'll avoid the loss of that 0.5% floor, right? So you won't lose the benefit of that deduction. And if you're in a 35% tax bracket, you're going to get your deductions are going to get limited also. So your full contribution next year, you might not get the full benefit from. Just something to think about, but that requires some strategy and some tax planning, right? Make your 2026 contributions now if you can. Or looking ahead, you can bundle your 26 and 27 contributions into 2026 to get a bigger benefit from them. And you might not be able to itemize at all, but if you bundle your contributions, that might give you enough to itemize in 26 and get a better reduction in your taxes. I hope that made sense. So the other thing to think about is your medical expenses. If you can, maybe bundle all your medical expenses into 1 year. So if you know you have some huge medical outlays or expenses, if you can do it, wait and do them all in the same year instead of the end of 2025 doing some medical stuff. Wait until 26 if you can afford it to do them all at once, and then you'll exceed that 7.5% floor, increases your a chance to itemize and take advantage of some of those deductions. And I'm going to say this, QCD, qualified charitable distribution. If you're eligible to make them, you have to be 70.5. If you're eligible to make them and you use QCDs for your charitable giving, it's always going to make the best sense to give through a QCD. Always, always, always. Okay, you're going to get, it reduces your income dollar for dollar. Okay, if you don't do a QCD from your IRA, and you itemize those deductions, if you're just gonna lose, you're gonna lose that benefit of the deduction. If you're in the 25% tax bracket, do the math, you're gonna lose, you're only gonna get the benefit of 25% of those deductions. So if you're able to do a QCD, they always is gonna make the best sense to do that, right, and reduce your income.
Okay, Carol, just a heads up, we're at 9 minutes to 11.
Okay, all right, I'll talk faster. QCD, Miss Catherine, is a qualified charitable distribution. It's something that you do right from your IRA. You have to work with your financial advisor or whoever's holding your IRA. They make the contribution on your behalf. You tell them, I want to make a contribution to the Arlington Neighborhood Village for this amount. They write the check, and it goes straight to whoever you designate the money to go to. Okay. And then it'll reduce your income dollar for dollar. So you're always going to get the bigger bang by doing your contributions this way if you're eligible. Okay. I can talk fast. I can talk faster. Okay. So it's always a good idea if you can to max out your retirement savings plans, especially if you do employer matching, right? Enough said about that. Fringe benefits, if they offer flex spending account, dependent care expenses, health savings account, those reduce your taxable income. If you work with a financial advisor, you've already heard this, they probably say this over and over again, sell some of your investments at a loss, you can exclude up to $3,000 of income every year. So that might help reduce your taxable income. We've already talked about the QCD. Okay, I'm not gonna go into that again. Roth conversion. Okay, so the QBBA really right now is a strategic opportunity to do some Roth conversion. So you're going to take money out of an IRA or a 401 and convert it into a Roth. Now you're going to pay taxes on it. However, with the lower tax rates that the QBBA offers right now, with the senior tax deduction of potentially $12,000, that might be an opportunity to convert some money now, because you would have paid, without that senior deduction, you would have been paying tax on $12,000 worth of income, right? So you might be able to take some money and convert it to a Roth and pay the taxes and still be in the same situation that you would have been without that senior deduction. So that's something I would tell you to talk to your tax advisor about and look at the numbers. It might make sense to roll over a little bit of money. And then that reduces your RMD in the future. So you're paying less tax on those RMDs in the future also. So something to think about. Generational wealth building. I talked about this earlier. So the changes to the 529 plans over the last couple of years. Let me. 2 years ago, I believe they made a change where it used to be your 529 plans. If our children didn't use that money to go to college, they took it out and used it for something else. Guess what? You're paying tax on that money, right? On the growth. So now if they choose not to use that money, you can roll the funds over into a Roth. There's a maximum amount that you can do per beneficiary. I believe it's $35,000. The limit is subject to the Roth IRA contributions, right? So you can do $7,000 a year and roll that money over. And then along with the creation of the Trump accounts, right, where you can start saving $5,000 a year for our children or our grandchildren. If you have grandchildren, you can put money into their Trump accounts, $5,000 a year. It's just a great way for tax deferred savings, excuse me, for our children. So that's something I would suggest you talk to your financial consultant about. And then also, you can talk to me if you have questions about that too. I'd be happy to answer them. All righty. So I am at the end of my presentation. I am so sorry. I know it was a lot. I threw a lot at you. I tried to keep it very high level. Is there any other questions?
Yeah, going back to the no unemployment for millionaires, the question is, what's a millionaire?
That's a
My
good,
house is worth $1 million, but my adjusted gross income is far less.
excuse me. I think that they're talking about wages. They look at your wages for the prior year or your self-employment income for the prior year. So,
Okay.
yep. Yep.
And they also commented that they're a widow, and so they assume that they won't be viewed as married filing single.
Yep. Yeah, you would be filing as single. Yep.
Okay. Next question, is there an amount that makes a QCD worthwhile? Like, is a $200 contribution worth the effort?
Um, oh, that's tough. Here we go. It depends. Miss Maureen, it depends. I would say if you want to make a charitable contribution, and if it's $200, it reduces your income by $200, right? So I would, I don't know if maybe somebody with more experience with the QCDs, if the holder of your IRA charges you fees for doing those. I don't know. So the fee might not be worth it. But if you're going to contribute money and you're eligible to do a QCD, I would tell you it'd be worth the effort. That would be my personal opinion.
And you can only do QCDs from IRAs, not 401ks?
Sure. Yes, IRA only. Yep.
Okay. Can you do an IRA rollover to a Roth if you're retired and not working?
Yes. Yep. You have to pay taxes on the money, but yes, you can do the rollover. You just can't contribute to your Roth anymore.
Okay.
Uh,
Can you do a QCD to several charitable organizations?
Yes, you can. Yes. And now like I said, there may be a limit depending on who holds your IRA. I don't know if they have rules that say we'll only do 10 checks a year or 5 checks. I don't know. But as far as the IRS is concerned, the answer is yes. You can do them to several organizations.
Are you recommending Roth conversions more in 2026 than 2025?
Um, I think it depends on your tax situation because the 2025, certainly we see you can do the senior deduction in 2025. We have lower tax brackets in 2025. So you could potentially, I don't know that I'm recommending one over the other. It depends on your specific tax situation. Because how much income are you going to have next year, right? So Miss Connie, QCD can help lower your your Medicare IRMA. Yep, and I didn't touch on the Medicare IRMA, but yep. It can because QCDs lower your income and your Medicare IRMA is based on, they do what, a 2-year look back? So yes, that can help lower your IRMA that you have to pay. Mm.
And can you do a QCD from an inherited IRA annuity?
That's a good question. Let me think about that. It seemed to me I had somebody that did. Yes, I believe you can. Yep. I believe that you can do that. Yep. I can do a quick search on that too if I have a moment. But is there any other question?
Well, if somebody wants to be able to do QCDs, but their money is in a 401k, would you recommend rolling it into a regular IRA or a Roth IRA?
So I think I heard, let me see if I can ask the question. So if they want to do a QCD,
Right.
QCDs can only be done from a traditional IRA. So if you have a 401, you could roll your 401 into an IRA and then do some QCDs.
And
Yes.
are there tax implications for that, or is that something that you can do without paying a big chunk of taxes?
Your 401k is pre-tax. Part of it is,
Yeah.
right? Your contributions are pre-tax. So you can take your pre-tax money and roll it into an IRA and then do your QCDs. So there's no tax implications on that. I actually did that when I worked for the federal government for years and I had a TSP and I rolled my TSP into my IRA and there was no consequence to that. So it could,
Okay, and we've got a comment here that you can do QCDs via an RMD, required minimum distribution, from a Roth IRA.
okay. I thought they were just traditional, but I might stand to be corrected here. And I do, sorry, not Roth. So what is,
Okay,
so
so
you meant
traditional IRA.
from a traditional IRA. Okay. All right. I was like, oh, challenge. Yeah. All right. Inherited. Can I do a QCD? I'm pretty certain you can do a QCD from an inherited, if I could spell right, inherited, because I think I did one of those for somebody last year. Can you do a, yes, okay, yep, you can do, I just wanted to double check that, yep. You can do a QCD from an inherited IRA. Yeah, so that's good. Are you guys seeing my screen? You watching me do the Google?
Yes, yes.
Well, there, that's embarrassing.
Well, it's always harder to type when you know people are watching.
Yeah, so you saw that too, right? Yeah. I can do taxes, I just can't type. And actually, I want you to, I do have, I don't think I have it open. I do have a service that I pay for. It's called, it's for tax professionals that I can do but it takes longer for that search engine to work. And it gives me tax law citations and it gives me, previous law cases and it gives me the code reference where Google doesn't do all those things for you. So, but I do have a service that provides that in my defense. All right. So I know, guys, that this was a lot. I tried to keep it high level. There was a lot of changes that happened with the QBBA. My contact information, I will make sure that Wendy gets the slides. Pat, yes, yes, welcome new clients. I have limited room. I try to keep my tax practice small because I want to be able to spend time with my clients, right? I want to be able to, I just don't want to do a tax return and be done with it and not really help with tax planning or do some strategy work with people. So yes, I am taking new clients. Feel free to reach out to me. Even if you don't want, if you're not looking for a new tax professional, if you have questions, I'll answer your questions. I'm happy to answer questions. If they're at a high level, if we have to start doing tax planning or some strategy work, then there's going to be a fee associated with that. But, if you have a question, reach out to me. Okay, you can email me. I would tell you that you can go to my website. There's a contact me form and you can send me a note real quick and then I will send you a link to my calendar to book time so we can have some time to chat. You can call me or text me. That's a text number there. Email me, but I'm happy to answer questions. Okay, feel free to reach out if you want. So, okay, Miss Wendy, thank you for that. Let me write that down. Wendy, CENK. .org. Okay, yep, I will, Miss Wendy, I will email you this presentation as soon as we get done.
Thank you
So,
very much. I know people will be asking for it.
okay, yeah, and I apologize. I should have gotten that to you sooner because I think
No.
we could have put it in the comments, right? We could have
Right.
downloaded it from.
Oh, who knows how to do that?
I can do taxes. I don't do Zoom. I'm gonna,
Right.
I'm gonna put that right out there. So,
So while my picture was off, I was listening to everything, and I have to tell you, of all the things I heard, the one that bothers me the most in terms of my stupidity
no,
was
don't
that
say
I was
that.
supposed to pay quarterly taxes this year, and I didn't, thinking that I would always, do it near the end.
Yeah,
And I just learned from you that doing it near the end is no better than waiting till May 15th.
yeah, because you're gonna pay penalties on that.
Right.
Yep. And then for me, it's more painful if I have to write a big check. And I know if I have to write a big check at the end of the year, that hurts more than I have to pay if I make 4 payments over the year. Even though it's the same amount, it's still playing games with your mind, but
Right. And for me, it's also the distrust of that. I know how to do last year was the first year I made an electronic payment
Mhm.
versus sending in a check. And I never went back to look and see, did they record it? Is it all right? But I
Yes.
have zero confidence in my ability to do that right.
Yeah, and that's where having an IRS account will go a long way to help because you can log into your account and then you can also see the history that you
Right.
payments. Yeah, so
Right.
yeah, excuse me. And don't call yourself stupid. Why do we do? No, you just
Hey,
no,
with respect to this,
it's not stupidity. You just didn't know.
uninformed, uneducated.
Uneducated. Yeah, I hate to because I think yeah, uneducated, and now you know.
Right.
Now you know. So it was worth sitting through this. Just you picked up one tidbit.
Yeah, it's like, ugh.
Yeah. I know it was a
Well, I
lot.
can stop feeling guilty about it, thinking that I have to do it before December 31st.
Well, still do it. If you haven't made them, I'm gonna tell you, if you have not made your estimated payments, make them. Because then the penalties and the interest and all those things start, they're adding up. And yeah, I would tell you to make them sooner than later.
Carol, and other people may, one of the things that also throws me off is the modified adjusted gross income. I understand that adjusted gross income is a line on my tax form, but somehow this concept of the modified adjusted gross income is not a line on my tax form, and somehow I'm supposed to be able to figure it out. Is
Yeah.
that statement correct?
Yeah, well, yeah, sort of. So what they do is there's certain, let me see if I can figure out an example.
And it comes to play with my IRMA calculation.
Or calculate, yeah, because they tell you that certain things count towards that, and I'm trying to recall a um a piece of
Well,
it.
yeah, and this is not tax, but it's just an annoyance that
It's
they
an
put so many
thing,
lines on the tax form. How come they can't just calculate that too,
yeah, because
rather than tell me I'm supposed to manually calculate it?
manual calculate. Well, if you're
Yeah.
using tax software, it'll calculate that for you, but
Oh,
yeah, and I'm off the top of my head, I'm trying to recall something that backs out of that makes that gross income modified. Um, and for the life of me,
go
you
ahead.
caught me off guard.
Carol, we've got one person joining me who's going to ask a question.
Okay.
Do you realize that I think the slide 24 with your email address is wrong? There should be an R in strategies. Is that right?
Oh my gosh. So yeah, so I can't spell. Thank you.
Yeah, somebody called me and let me know.
Well, I'm glad that somebody caught that because yeah, obviously I can't spell. So, and that's yeah, I will make sure I correct that.
Okay.
All right, like I said, I keep going back on the fact I can do taxes. I can't do Zoom, correct?
You got numbers, just not letters.
I got number, there you go, email address. Good catch, thank you. Now, see, if I was smart, I would have said I did that on purpose to see how much people were really paying attention.
Well, now you know.
Yeah, I'll make that change. Thank you. Is there anything else? No. No other questions. So yeah, please, if I can help answer any questions, I'm happy to do so. Like I said, even if you're not looking for a new tax person, questions about something that I talked about on the briefing, I'd be happy to answer those for you. Just feel free to reach out. Okay.
Well, this has been great, Carol. I can't tell you, I mean, you made it very enjoyable to
Well,
listen
thank you.
to all of this. And the day before, people are cooking turkeys, etc.
There you go.
We had a great turnout.
Yeah. Well, I appreciate that. Yeah. And I'm thankful this year I'm not cooking. So that's,
Okay. And thank you to Connie Sorrentino, who put
yes,
us in touch with you.
yes, Miss Connie, thank you. Yeah. She's still here?
Yep, she's up there.
She's still there? Yeah.
Yep.
Yes, I'm here, and thank you, Carol. That was, in my opinion, very excellent, well organized, and I learned some things. So thank you.
Good. Yeah, I'm happy. I'm happy that I hope somebody got at least one or two tidbits out of it. And like I said, call me if you have any questions. It was my pleasure to be here. And everybody have a happy Thanksgiving. If you if you're traveling, please be safe. Lots of
There was one last question, Carol. People, you said at the beginning, we're asking where were you geographically? And I know you said it, but I'll leave it up to you to tell people.
I am in Front Royal. I do have a lot of clients down in Bailey's Crossroads that are in Goodwin House. So I do some traveling down there. So if the situation, if somebody's not comfortable doing virtual, I can make some accommodations for people that if I got to go to Bailey's Crossroads to work with clients, it's just as easy to go to Arlington, right? Or someplace
Right.
like that. So, yeah, good.
Perfect.
Jackie, good. Jackie says, I'm off to see my accountant. Good. Carol said, Carol.
All right. Well, thank you, everybody. Have a great
Thank
Thanksgiving to
you.
everyone.
All right. Thank you. Happy Thanksgiving.
Okay.